We're entering into the second week of the turmoil in the Middle East, and the markets continue to sell off into the ongoing headline news that we get coming out of these events. It is Monday, March the 9th, and this is Markets with Megan. If you like this podcast, you can subscribe, hit the alarm bell, share it with your friends, family, or colleagues. But we want to come today to talk about specifically the focus right now, and that is in the Strait of Hormuz. Now, no one wants to see any lives lost, and it's a tragic event that we're seeing unfold in the Middle East. And we don't know exactly when this is going to end. It's looking like with the appointment of the new Supreme Leader that this may not end as quickly as the White House had anticipated. So markets are weaker today in anticipation for this to intensify, and also with the disruption we're seeing in one of the most important waterways around the world. The Strait of Hormuz carries 20% of the global seaborne oil trade, and right now traffic is down about 90 to 95% here. It does carry about 20 million barrels a day, so if this continues at a standstill, we're talking about $20 million a day less of oil coming around the globe. Now, this is a storage issue right now. It's not necessarily a supply issue because of the war. That's because most of the oil producers can still produce oil, but they just don't have anywhere to store it. So what they're doing is, you're going to hear a lot of headlines about cutting production. There are some that are cutting production, but there also are countries that are, instead of cutting it, are shifting production to other areas so that they either have more storage or maybe a better passage for the transportation than using the Strait of Hormuz. These details are coming out regularly, hour by hour, really minute by minute. It could have changed since the time I came down here to record this podcast. So what we're seeing on the market side is this uncertainty on how long the transportation issue will go on. Also, the fact there's hundreds of tankers sitting outside of the Strait of Hormuz with really nowhere to go. We've seen oil prices skyrocket above $100 a barrel. We're also seeing pain at the pump. This is something consumers will start to be discussing. We're looking at the average price of a gallon of gasoline rising almost 70 cents, from its January low to about $3.48 for a regular gallon of gasoline. The risk impact here from the equity side is broad-based declines we're seeing continue into today. We're still looking at somewhere between 5 to 10% pullbacks, and it depends on where. The U.S. is is not leading this weakness. It's being led by the emerging markets in Europe. In the U.S., we are seeing the bigger weakness in those high PE sectors, growth stocks. That's because we're seeing interest rates higher, and that threatens those high PE sectors. When we talk about what we expect to happen going forward, and we've been regularly coming to you with updates as they come out. First of all, we've looked at a bunch of different scenarios where there's been aggression or tensions in the Strait of Hormuz. And nearly every one of these scenarios, going back to the early 80s, proves to be a buying opportunities for equities, and oil prices do not stay that high for long. They're actually lower a year later. That's positive. Right now, the biggest concern is stagflation. I know that when we hear stagflation, it's a very ugly word. I don't think this is a prolonged period of stagflation, and it still is just a risk. We're not saying we're there yet. The risk being that this can and most likely will impact consumer spending in the near term. A lot of the spending has been led by the upper end consumers spending, but when you start to talk about weakness in the labor markets, that's where that net wealth effect comes into play. So you're not only being hit on your investments, but you're also being hit now with pain at the pump. So that can result in a pullback in spending, but there still is a lot of good underlying fundamentals in the U.S. economy that we don't think that you should sell into this. It's sit tight, remain patient. These things are ugly to see on a regular basis. The headlines are disturbing, but when we sit and remain disciplined and patient on the long run, history tells us these do not have very long lasting effects. The inflation, we have recommended a short duration in fixed income portfolios. We still do. This was regardless of what happened with Iran. Remain short though, because inflation expectations will result in longer-term Treasury yields going higher. So be defensive there. The Fed's probably not going to be cutting rates anytime soon. We don't expect any changes at their March meeting. In fact, we may be in the summer before we start to get talk of if rate cuts are even still on the table. From an equity perspective, like I mentioned, we're looking at all of the different all of the different equity sectors right now, and we're looking at valuations and have they fallen enough that warrant that long-term risk. We know that it's ugly what we're seeing every day with the Dow down 500, 600 points, but remember, we came into this conflict with valuations extraordinarily high, and even though we've seen a pullback, they're not really extraordinarily cheap yet. They may get there, but some of the things that we do have cash to put to work, and we've been looking at some investments before this that we would love to see to get cheaper, and that's what we're looking at now. Are these things cheap enough to warrant that risk? It's not a rush. We still think that there's time. We're going to do our due diligence, and we will look at if we will be paying the appropriate price for the risk that is likely to continue in this market. That's all we have today. If you want a history of our podcast, you can go to marketswithmegan.fm. Thank you.